So in a previous video, I explained what a journal entry is and how you would go about recording a journal entry in your financial records. And now I think it's a good that we get some practice with the different account types and get a feel for how it goes in terms of making journal entries on a regular basis. So I've got some transactions here, and we can think about what the transaction is, what's going on, and how we would go about recording it with a journal entry. So you decide that you want to start a business. So let's say this example, you start a business where you're going to have a food truck. Start a business. You're going to buy a food truck and you're going to drive up to the parking lot at people's place of business when they decide to have lunch, and you're going to try and sell them food. So it starts with you've got here you are, and then here's the business, right? So you invest $50,000 of your own money. You take your personal savings and you put that into the business. So now we want to think about the journal entry, I'll just abbreviate it here, JE, from the perspective of the business, not from your perspective, but from, so what's happening to the business here? So the business is getting $50,000, right? $50,000, and $50,000 cash is being invested in the business. And so that's an asset. So the business now has an asset. So we need to make a debit to record this asset. So the business is going to get $50,000. As a debit is an increase, and now we're actually going to have a corresponding entry. Remember our double entry accounting. We're going to have an increase in equity, owner's equity, or shareholders' equity, or whatever you want to call it. In this case, you're just the only owner. So actually, owner's equity will be going up $50,000. So we debit cash, credit owner's equity for $50,000. What does this mean? That means the business has received $50,000 in cash, but now the owner of this business has $50,000 in equity. So if we think about our accounting equation, we've got assets equal to liability plus stockholders' equity, owner's equity, however you want to think about it. We've got assets are going up $50,000 and equity is going up $50,000. So this balances. So now let's think of another kind of transaction that could take place. You might purchase equipment for your food truck in order to cook the food. So when you purchase this equipment, you're going to have to make a journal entry for that. And so what you're going to do is you're going to take the equipment, right? So you're getting this equipment. You're getting an asset. So we need to record that. So we're going to debit equipment. Remember, assets increase with the debit. So we're going to debit equipment for $6,000, right? It's basically saying we've added an asset. We've added $6,000 in equipment. So, but we also have an asset that's going down here. We have cash that's going out. So we're going to credit cash because assets decrease with credits. We're going to credit cash for $6,000. Remember, we indent our credits. Okay, so we're debiting equipment $6,000 and crediting cash for $6,000 when we purchase this equipment. So let's think of another potential entry we have. Well, you're going to need a food truck, right? You're going to need to buy a truck to bring people their food in. So when you buy this food truck, you're going to be debiting an asset account. You're going to debit, you can just call it truck. I mean, technically, I guess you call it equipment or vehicle or something else, but we'll just call it truck. That's easy to understand. And the truck, we're going to put it on at cost. It costs us $15,000. So we debit this asset account for $15,000. And then now we're buying it on credit. So what does that mean? That means that we're not paying cash. We're telling the dealership or whoever, we're basically telling them, look, we'll make payments, or we'll pay you at some point in the future, maybe in 30 days or something, whatever the reason. We're going to pay them at some point in the future. And so what we do is we call that accounts payable. So I'm just going to abbreviate accounts payable. It's usually abbreviated A/P, accounts payable. Now, accounts payable is a liability, right? It's on the right-hand side of that accounting equation. And remember, credit means right. So since this is on the right-hand side, it's going to increase with a credit, which means we've got $15,000 over here as a credit. And that means that, of course, this entry balances. We're debiting an asset, so the asset side is going up, and then we've got a liability going up for the same amount, so our accounting equation balances. So now let's think of another transaction we might have. Well, we're going to need to sell food, but we need to buy some food. Whatever kind of food it is, we need to buy it, and then we can go ahead and prepare it in our food truck. So when we buy this, what we're really buying, we can think about it as inventory, right? So we're buying inventory, so we debit inventory because our inventory is going up by $2,000. We now have $2,000 worth of food. At the same time, we're paying out cash, right? So we've got another asset account that's actually going down. So we're going to credit cash for $2,000. Okay. Now, if we had bought that food on credit, then we'd credit accounts payable, but we didn't. We paid cash in this instance. So we're just we have the assets going up and the assets going down. Up by 2,000, down by 2,000, so there's no effect. So now we go, and ideally, you want to be able to sell the food that you bought. That's how you make money. So when you sell this food, we're actually going to have kind of a couple journal entries going on here. So I'm going to give myself a little more space here to write this down. Because when we think about it, let's just think, okay, what's happening here? So we're going to sell all this food, all of it. We're selling now for $4,000. So we know that, and now we're selling it for cash. So that's the easy part. We can figure out what's going on with cash. We know cash is going up by $4,000, right? We can see that. That's not hard to see. And what did we do here? Well, we sold something, right? We have a sale. So what do we do with that? Well, we're going to credit sales for $4,000. Now, why are we crediting sales? Well, remember that sales increase equity. And equity is on the right-hand side of that accounting equation. Credit means right. So because it increases equity, increases in equity are reflected with a credit. So we debit cash for $4,000 and we credit sales for $4,000. But we've got something else going on here too, because remember, we recorded that food as inventory. But now we don't have that $2,000 of inventory anymore because we just got rid of it. So we have to credit or reduce the inventory balance. So we credit inventory, and we credit inventory for $2,000 because that's what it was on our books for, right? That's what we paid for it. So we credit inventory for $2,000. But now you see that we've got $4,000 over here, and if we add up the right column, we've got $6,000. Now that doesn't balance, so we need something to make this balance. And the thing that we're going to have, it's called cost of goods sold. COGS, cost of goods sold. Cost of goods sold is basically an expense. Even though we don't technically call it an expense, it acts like an expense. It's something that we would reduce our equity, right? This is so what we're going to do is we're going to take that $2,000, right? That's the cost of the inventory, and we're gonna basically expense this or put it to cost of goods sold, and that's a reduction in the equity, right? So now remember that increases in equity, like sales, are reflected with a credit. So a decrease in equity is reflected with a debit. That's why we have cost of goods sold is being debited. So ultimately, there's kind of four things going on in this transaction, right? We're debiting cash for $4,000 and crediting sales for $4,000, but we're also debiting cost of goods sold for $2,000 and crediting inventory for $2,000. So let's get to some more examples here. So let's say that you had an employee that worked for you, and they worked the entire week, and at the end of the week you realize, okay, this person has earned $500. So now you need to make, even before you even pay this person, you basically need to make some kind of entry to reflect that you basically had wages expense, right? I'll just abbreviate that EXP of $500, but you haven't paid it yet, let's assume. So we'll call that the credit is wages payable, right? So wages payable is a liability, as all payables are. So it's going to increase with a credit. And then we've got an expense. And remember, expenses reduce equity. So they are going to be a debit here. Okay, so we're debiting an expense and crediting a payable, which is something you'll commonly see in accounting. Then we go ahead, now we say, okay, you know what, we owe this person $500. Now the next day or whatever, you go ahead and pay the employee, right? So now you're actually paying them the cash of $500. So now we have to make an entry to reflect that. So what are we going to do? Well, this payable is no longer payable, right? We're paying it. So we're going to debit it to reflect that it's no longer owed. Right? If we just left that there, it would look like we still owed somebody $500, but we don't. So we're going to decrease this payable. Okay, payable is a liability. Liabilities increase with a credit, so they decrease with a debit. So we're going to debit this payable to say, okay, it's been paid, but we're paying $500 cash to pay it. So what happens to cash, the asset account? Cash is going to go down by $500. Now, if we think about that with our accounting equations, just think about this last one. We got assets equals liabilities plus equity. Okay, so let's think about what's happening with this transaction right here. So we've got a liability, wages payable, that's going down by $500. And then we've got an asset, cash, that's going down by $500, right? So we go down 500 on the left side, we go down 500 on the right side, everything balances. Everything is equal. This equation holds, and those are some typical journal entries that we do for our business.